Welcome to the deep dive. We take the mountain of market chaos, distill the key signals, and we hand you the intelligence you need to stay ahead.
Our mission today is, well, it's a deep dive into some real financial irony. In just 24 hours, the crypto market got hit by this shockwaves, wiped out over $217 million in leveraged bets. Just poof, gone.
Yeah, gone. Yet at the exact same time, you've got these billion-dollar institutional funds just pouring into the same asset class. They seem to treat this kind of volatility like, I don't know, minor detail.
It's a huge contradiction.
Exactly. So we're here to understand how this massive, almost explosive chaos can coexist with these, frankly, unprecedented institutional adoption signals. We need to unpack the mechanism here.
And just quickly, for those of you following along, maybe doing your own research, we do have the best referral link down in the description for, all your market exploring tools and needs.
Okay, let's get into it. The gory details of that wipeout. We're talking about market structure basically turning against traders who got a bit too confident, right?
Uh-huh. The shockwave, it really started with the big players, Bitcoin and Ethereum, but the destruction that rippled across the whole ecosystem.
That scale, it's hard to wrap your head around. Over $217 million liquidated?
Yeah.
In one day.
It is. Imagine, like, a really badly designed, super expensive water park ride where everyone gets thrown off. You're getting close.
Okay, so tell us about the riders who got completely soaked on this one.
Well, the majority of the pain, it seems, was felt by the optimists. Roughly $167 million came from long positions.
So traders' betting prices would go up using borrowed money.
Exactly. They were using leverage, betting on a quick rebound, and the market gave them the exact opposite, swiftly.
So the high-leverage bulls got hit hardest, but I heard even the bears, the short sellers, weren't safe either.
Not at all. About $50 million got wiped from short positions, too.
Which really highlights the mechanics of it, doesn't it?
It does. It underscores that when prices start whipping around that violently, the market doesn't really care what you believe. It's just this indiscriminate force cleaning house on both sides of the trade.
Okay, that brings us to the core mechanism then, this liquidation cascade. How does one price move cause, hundreds of millions of dollars to just evaporate instantly?
It's a self-reinforcing cycle, almost purely mechanical. So picture a market that's saturated with these high leverage bets, people borrowing maybe 10 times, 20 times their actual capital.
Okay, highly exposed.
Very. So when Bitcoin or Ethereum drop sharply, even by just, say, 2% or 3%, those super leveraged positions, they immediately fall below the required margin level.
And that triggers the automated margin call.
Yep.
The exchange basically says, uh-oh, your safety net's gone, you need more money right now, or we sell your assets.
Precisely. And the exchange has to sell that collateral automatically to cover the loan. That forced selling instantly adds more selling pressure to the market.
Pushing prices down even further.
Right, which then triggers more margin calls for the next group of leverage traders, forcing more selling. It's this classic domino effect. It drives the price lower than maybe you would have naturally gone.
And it drags everything else down with it, like Solana, XRP.
Yep. Solana, XRP, Dogecoin, they all got pulled down in the wake. Shows how dominant BTC and ETH still are in setting that overall market mood.
Okay, so culprit identified, excessive leverage. It turns what might have been just a normal market dip into this structural failure. What makes traders take on that kind of insane risk? Is it just pure greed?
It's that constant search for amplification. Leverage really is the classic double-edged sword. It offers absolutely phenomenal returns if you happen to be right. But it turns even tiny little adverse price moves into catastrophic instant losses. If you're using 10x, 20x leverage, you're essentially saying, I'm so sure about the next few hours of price action that I'm just going to ignore basic risk management.
It's like flooring it in a supercar with completely bald tires. Amazing if the road stays perfectly smooth.
Disaster the second you hit a small bump. Yeah.
But you mentioned maybe a silver lining here, a sort of painful market detox. How is losing over $200 million possibly a good thing for the market?
Well, structurally, analysts argue this kind of pain actually serves a purpose. They call these big liquidation events clearing weak positions, meaning all the overconfident, highly speculative leverage gets flushed out, just removed from the system entirely. This painful, quick reset helps prepare the ground for what they hope is a more sustainable recovery.
So the idea is the market is maybe a bit healthier now because the, let's say, weak hands or the irrational gamblers have been kicked out, leaving traders with stronger positions and maybe less crazy speculation.
That's the theory, yeah.
Okay, if this cascade is like a structural detox, what's the one big lesson traders absolutely must take away from this?
It's a really harsh reminder about risk management, honestly. It just hammers home the need for basic protections, like setting stop-loss orders,
Yeah.
actively monitoring your leverage ratios. Because the fundamental truth of this asset class is high risk is just part of the game.
Right. And here's where it gets really interesting. This is the core contradiction, isn't it? We've just described this chaotic, almost self-destructing environment.
Mm-hmm.
How can huge players like BlackRock be pouring in billions while $200 million is just exploding elsewhere? Doesn't that kind of risk profile just scare institutional money away?
Ah, that's the key distinction, and it explains the contradiction perfectly, I think. The institutional capital, it's largely moving through regulated spot ETFs.
Okay.
The retail traders getting caught in that liquidation cascade. They're playing in the, frankly, much more dangerous futures and derivatives markets, often with that excessive leverage we talked about.
Ah, okay. So the institution buying Bitcoin through a spot ETF is just holding the actual Bitcoin. They're insulated from the margin calls and the forced selling that happens in the leveraged futures market.
Exactly. For them, it's a long-term allocation. It's not a frantic day trade. They see a price dip, maybe caused by retail panic, and they likely see it as a buying opportunity.
The data seems to back that up.
Oh, yeah. Look at the numbers. Bitcoin spot ETFs pulled in a net inflow of $149 million in just one day, nearly $1 billion a week before that. BlackRock's IBIT fund alone now holds over 800,000 Bitcoin.
Wow.
So institutions aren't just undeterred. They seem to be increasing their average crypto allocation. It's around 5% now, reportedly. They're buying the efficiency and the perceived safety of the regulated product.
Okay. That bullishness on Bitcoin, though, it seems to contrast pretty sharply with what's happening with Ethereum products recently. What's the story there?
Yeah, that's different. The Ethereum products actually saw $169 million in outflows last week. That adds up to over $500 million in outflows for the month.
What does that suggest?
It could suggest some high-level capital rotation. Maybe investors are shifting away from ETH, perhaps towards the perceived relative safety of Bitcoin, or maybe they're looking at newer growth stories like, say, Solana. Or it could just be caution.
Speaking of growth narratives and Solana, the institutional on-ramp used to be pretty much just Bitcoin and Ethereum, right?
Mm-hmm.
What are we seeing now in the altcoin space?
We're seeing really rapid infrastructure expansion there. The first U.S. bought altcoin ETFs for Solana, Litecoin, and Hedera, they've actually launched now.
That feels significant.
It's massive because it expands that institutional ledger channel way beyond just the original two giants.
So instead of institutions just like speculating on altcoins from afar, they can now offer regulated products tied directly to assets like Solana, which is known for speed, or Hedera, with its enterprise angle.
Exactly. This isn't just passing interest anymore. This looks like the construction of a permanent financial rail system for potentially the entire asset class.
And this build-out is happening while regulators are still figuring things out.
Well, it seems like it's happening alongside continued regulatory integration. We just saw the White House nominate Mike Seelig. He's a known crypto policy lawyer to lead the CFTC.
Okay, what's the signal there?
The signal seems to be that the regulatory framework is actively being built, and it's being staffed by people who are focused on integrating digital assets, not necessarily just blocking them. It's like the adults are moving into the playroom, but they're wearing suits and drawing up proper building codes this time.
Right, okay. So the chaotic leverage seems to be cleaned out for now, and the institutions are digging in for the long haul. What does all this mean for price action right now? The market reacted to the liquidation, sure, but it's still watching those traditional macro signals like a hawk, isn't it?
Oh, absolutely. That nervousness is palpable. Traders are heavily anticipating a Federal Reserve rate cut. The market's pricing in like a 98.3% probability of a 25 basis point cut.
Wow, near certainty.
Seems like it. And they're eagerly waiting for the next U.S. inflation data. Those traditional finance triggers, they're going to drive the short-term volatility most likely.
Yeah. Okay, so given that violent shakeout we saw, where are the key technical levels, the battlegrounds traders are watching right now?
For Bitcoin, the price is kind of stuck in this consolidation range. The crucial thing is it found support around $113,500. That level is a big psychological floor, and it was an area where buyers stepped in before.
So holding that is key.
Holding there keeps the near-term outlook, let's say, cautiously positive. However, the really critical level it needs to break to confirm any kind of bullish follow-through is $117,630. That resistance needs to shatter to signal real strength.
And what about Ethereum, especially after those outflows we discussed?
ETH is basically challenging a major resistance area right now. It's defined by previous cycle highs, roughly between $4,232 and $4,193. This is a real make-or-break zone for ETH.
So rejection means?
A clear rejection there could easily push the price back down towards maybe $3,800 or even the $3,500 demand zones. Meanwhile, XRP is showing a lot of indecision. It got rejected at $2.68 resistance, but it seems to be finding some stability around its long-term trend line, the 200-day moving average, which is about $2.61.
All right, so let's recap. We covered the immediate, very sharp pain of that excessive leverage getting wiped out, $217 million, gone in that spectacular liquidation cascade. Really showed how the market can sometimes inflict self-harm.
But we also saw that fundamental contradiction playing out. While some retail futures traders were panicking, institutional capital using these regulated spot products seemed to view the dip as just a sale. And they're continuing to build out massive infrastructure, now even including new altcoin ETFs for assets like Solana. The whole market structure feels like it's resetting, definitely under increasing regulatory scrutiny.
I think the ultimate takeaway from watching $217 million just vanish like that is pretty simple. You have to manage your risk, because that high leverage, it absolutely cuts both ways. So the golden sentence for you to remember today has got to be, volatility is the price of opportunity.
You pay for the chance to make those big gains by accepting the risk of, well, spectacular failure sometimes.
Yeah.
And just a reminder, of course, we're reporting on market events as they happen. We are definitely not offering any investment advice here.
Absolutely not. So here's the open question we want to leave you with. With those weak, highly leveraged positions now largely flushed out and the institutional infrastructure for altcoins rapidly expanding, is this market actually setting up for a more stable, maybe ETF-driven uptrend? Or should traders brace themselves for maybe one more deep technical correction before real confidence rebuilds? Something to think about.
And don't forget, we have that referral link in the description below for market research tools if you need them.